Hey everybody, welcome back to the Compliance Coach, episode 10 already, and we're talking about conduct risk. What does it mean? So in this episode, you will learn three things. Number one is what are the top scandals over the last 15 years in banking related to conduct risk. Number two is why human behavior is often called the hidden risk, especially when it comes to banking. And three is what are the top three strategies from a compliance perspective to reduce such risk. In the words of Simon Sinek, there's only two ways to influence human behavior, either by manipulation or by inspiration. So we will look at how we can inspire the financial industry to change its behavior. My name is Ralf Ebert. I'm the compliance coach, 20 years of experience in banking, in senior compliance roles. I'm here to talk about compliance for beginners and advanced persons. So stay with me, thinking and impacting compliance differently. So let's talk about the biggest scandals in banking in the last 15 years related to conduct risk. So conduct risk as such is the inappropriate behavior or unethical conduct of individuals causing a financial loss. You might think, yes, I heard of that. 2008 is a good example. Yes, you're right. 2008 is an extremely good example of where misbehavior of a whole financial industry has caused a huge loss, not only for the industry itself, but as well reputation, etc. So can we think now in 2024 that we have learned from that element? I'm not so sure, because if we look on the last three scandals that has happened in the last 15 years, the truth might be different. So let's start with all three of them. Let's start with the first scandal. Already in 2012, the so-called LIBOR scandal happened. Now, what's it about? It is manipulating a key benchmark interest rate, which was used globally by traders. And that has been done, of course, in terms of getting a financial gain. And unfortunately, it was even a collusion of several global banks of achieving so. So that has, of course, generated a high mistrust in the market. A lot of investors started legal procedures, and up to Bloomberg estimations, the total fines that banks envisaged in this really disaster, we can say, was up to 9 billion. So quite substantial element already coming from this kind of super conduct risk that we have seen in 2012. The second scandal came in 2016 with Wells Fargo Bank. What did they do? The bank put up quite ambitious, let me say, sales target. And the sales staff then started to open up unauthorized accounts. Of course, customers faced additional fees that they were never aware of. So litigation started. In essence, it led to a huge reputation issue for the bank. 3 billion of fines in a settlement. CEO resigned. Governance had to be changed, etc. So that's number two. The third scandal is quite recent, in 2021. This time it was HSBC, which encountered by the FCA in the UK a penalty of £64 million, only this time. But it was with regard to the weakness in transaction monitoring. Normally, a bank needs to address quickly whenever there is an alert on the account, whether there is a suspicious activity, yes or no. And they, despite internal and external reports which showed that kind of weakness, continued in that way until the regulator stepped in and fined the bank. And that was quite surprising, because HSBC was already in 2012 with a 1.9 billion penalty in the focus of the regulators. This time, however, with regard to much more serious stuff, with allegations to money laundering in the Latin America region. So this time as well, you see that banks do not often learn from their failures in the past when it comes to conduct risk. Now, let's have a look in terms of why is conduct risk still an issue. But before that, one element that has as well changed over the last years is the regulatory environment. That doesn't mean only that the regulators have come up with a new kind of reporting, regulations in particular on market abuse to define what is allowed and not. It's as well the technology has changed. That meaning today the regulators are asking for raw data to be submitted, which sometimes give them the possibility to check your data within the bank. So that is, of course, a whole element that has been not so present in the years before. Now, the question is always, is this conduct risk already existing for a long time? Or is just because the regulations have changed and the technology has gotten better, that therefore there are more cases that have been identified? Up to you to decide that. Now, I have found out in essence 3 elements which are related to the conduct risk, and I think it's already what you found out in the, diversity of the misconduct scandals that we had already talked before. And number 1, it's the cultural influence, and that means it is as well the organizational culture of how a bank is organized and which kind of roles are played, how the tone from the top is performed, and how far key performance indicators are as well related to conduct factors and how the conduct and the behavior of a staff member influences that. So I think that is, and I think the most important one in this one, so don't forget about the cultural influence. The second one is the behavioral topic as a human factor has shown that there is often a very clear topic of overconfidence, like sales targets, we make it, don't worry, we invest whatever we can of doing so. So that is very often that leads on the business side in terms of over-investing and disregarding these kind of ethical parts. And on the other side, when it comes to compliance or the second line of defense, as we call it, very often is that these kind of red flags are just overlooked. Yeah, and I think what we have seen already beforehand in the LIBOR case or in the Wells Fargo case, that has been already identified beforehand, and nobody really raised then the voice by saying enough is enough and now let's investigate. So behavioral biases are as well a key trigger in this regard. And the third one is the interconnected risk, and that is what we mean by that. Conduct risk is called sometimes the hidden risk. Why? Because, as I already said beforehand, there is very few data out there. So sometimes you can create specific data to see in terms of how traders are behaving with their clients. Do they do what we call fronting, or do they try to copy exactly the same kind of tradings done by their clients, so that you can normally quite easily see in the trading flow charts. But when it goes not only in one dimension, but the personality as such is under question, and the behavior does lead to operational risks and compliance risks. So it's an amalgam of reputation, compliance, and conduct risk. So I think that is as well very related to this one, that the systems in the bank try to see it on a holistic level and not individually. And as the lack of data in the moment is present here, that is still a topic to be taken into consideration. So cultural organization part, behavioral biases, and certainly the interconnected risks to the lack of data. Now let's come to the 3 compliance strategies in order to address this conduct risk. And I think it's only a reducing of this factor, which is really in the moment at stake, not the complete avoidance, because banking is human, because we are working with humans for humans. So as we have talked already before, and the behavioral part is incrementally involved. So what does that mean? So 3 elements I've found out which could literally help us to combat the conduct risk and the related actions. Number one is, of course, creating awareness. So trainings need to be adopted within the financial industry to make clear what kind of behavior is under surveillance and what does it mean, and how the actions of an individual can lead to a high reputation risk for the bank. Very often it's then related to how much fine you can get individually and the bank as an organization. I'm not so convinced that that is the best element. I think moreover, if you look at on a broader element in terms of how you can incentivize people of changing their behavior, that might be better. But awareness training is really the kind of foundation to get people guidelines at the end. What is expected from them? Is it a code of conduct, and how does the code of conduct needs to be lived in the offering of financial services, in the execution of trades, etc. So I think back to the basics, training is number one. The second topic is, and people always call it finding the needle in the haystack. Why? Because we know that data is king for finding out what is happening in the bank, and especially the conduct data is in the moment not holistically organized within banks. As I mentioned before, and sometimes you have for trading and trading surveillance, monitoring these elements into place, but they're not holistically related and interlinked to give a clear picture of what is happening. So data and needs first of all to be put back into the system, and of course then you need to provide data analysis capabilities in forms of tools, whether it is to transaction monitoring, trade monitoring, surveillance, communication surveillance as well, in terms of what people are talking with the clients or with each other. So it's a quite vast dimension of what needs to be elaborated, and what you need first of all is the right set of data, then the right set of tools, and finally the right thing of calibration, or in order of getting out what you would like out of the system. So it's a long way to this. I will certainly dedicate another episode on this topic in particular, as it is not only for conduct risk very relevant, but as well for other factors such as money laundering, for instance, and so on. And the third one is for me the most important one. And those ones who are listening to me for already a certain time will find out that I always look and believe in the human part of compliance. And not by coincidence, in 2019, the FCA at the time, so the regulator for the UK, launched 5 conduct questions where they came to the conclusion the main topic or the main action to be addressed is really the tone from the top. And I think that's quite interesting, a part of trainings, data improvements, tool enhancements, that the real element might really lie into the corporate and compliance governance and what we call compliance culture within the bank. Now, how can that be done? And I think what I have seen in the past is it is really the focus on integrity, and that starts with compliance officers. If you have compliance officers which do not have an understanding what is integrity for them in their daily work, it will be very difficult to build with them a compliance culture within the bank. So the topic must be to create accountability and responsibility, and promoting really ethical behavior in the bank as being that is what we want to see. And funny enough, you can of course bring that into KPIs, management information that helps then for the reward element, bonus payments, etc. as this one, or a malus, meaning whenever persons have not reacted as it was supposed from a conduct perspective, they get then a negative part on this one affected to the bonus payment. I think it's more valuable as of today to show people on what kind of problems can come up whenever they behave not correctly. And what I find out is always the best is having a clear business case where you can show what has going wrong. And I think the initially discussed 3 cases are very good in that regard. But I think it's even sometimes we have to learn from failures, and therefore it is really good of having the possibility, having clear cases of with the relationship manager or the staff working in the bank where you can relate to this. So what I do personally, and so I combine, I think, number 1, awareness training, and number 2 is the promotion of ethical behavior, is taking real business cases and then formulate them on an anonymous way in a deck of presentations, and you will see normally that people are much more adhering to this one, and that has a much more bigger impact than referring to theoretical elements of what is the fine on an individual level and organization level whenever misconduct is out there. So these are my 3 top compliance strategies to fight conduct risk within the banking sector. That was it for this episode on conduct risk. So as you have seen, it's not a tick the box exercise. It's maintaining and regaining the trust of the regulators and the trust of the customers. I think that is what it's about. So again, the human touch of compliance. Thank you for listening to this episode. Don't forget to subscribe, and I hope to see you soon on this channel, thinking and impacting compliance differently.